All right, so today we're going to try and unravel a real head scratcher in the tech world. We're talking about UiPath, a company that's right at the center of the whole AI boom. But at the same time, it's sending out some seriously confusing, contradictory signals.
It's like a tale of two companies. On one side, you have all this incredible hype. UiPath is a big deal in agentic AI, which is basically AI smart enough to do complex jobs all by itself. They're making a profit, they're teaming up with the biggest names in tech, and they just got added to a major stock index. But then you look a little closer and whoa, you see this dark cloud of lawsuits, slowing growth, massive competition, and maybe the most confusing part, the CEO is selling his own stock. So what on earth is actually going on here?
So let's start with the good stuff, right? Let's unpack this side of the story that had investors so optimistic. And, it's pretty easy to see why. I mean, just a little while ago, the buzz was deafening. They get added to the S&P Midcap 400, which is a big stamp of legitimacy. They finally hit GAAP profitability, which for any tech company is a huge, huge milestone. They're launching cool new AI products, and they're linking arms with the absolute titans of the industry: OpenAI, NVIDIA, Microsoft, Google. On paper, this company looks unstoppable. And it wasn't just talk. The numbers were there to back it all up. In their third quarter, they pulled in $411 million in revenue. And that wasn't just good, it smashed what the analysts were predicting. And get this, it wasn't just some fluke quarter. That number represents a solid 16% jump from the year before. That's the kind of healthy, consistent growth that investors absolutely love to see. This next number really speaks to the stability of their business. Their annualized renewal rate, or ARR, is sitting at nearly $1.8 billion. Now, what's ARR? Well, think of it as the predictable, recurring money they get from all their subscribers. A high number like that tells you they've got a really sticky product and a loyal customer base. Okay, so everything looks great, right? A perfect picture. But this is where the story takes a turn. Because when you start digging just a little bit beneath that shiny surface, you start to find some pretty serious cracks. You can really trace the trouble back to 2024. That's when things started getting messy. First, you've got these class action lawsuits popping up, basically accusing the company of not being straight with its investors. Then, bam, in May, they slashed their own revenue forecast. That's a huge red flag, and it absolutely hammered the stock, totally crushing investor confidence. And these legal headaches, they are far from over. And this chart, wow, this chart really tells a story. Look at this. Back in 2021, around their IPO, they were growing at a mind-blowing 80%. Just explosive growth. Now, we're looking at just over 9%. That's not just a slowdown. That's like slamming on the brakes. For a company that's supposed to be a growth story, that is a massive